In 1637, something impossible happened in the Netherlands. A single flower bulb, no bigger than an onion, sold for the price of a grand Amsterdam townhouse. Not the garden, not the furniture, the entire house, complete with a coach house and servants' quarters. And this wasn't an isolated case of aristocratic madness. Ordinary people, bakers and cobblers and tavern keepers, were trading their life savings for tulip bulbs they'd never even seen, bulbs that hadn't yet bloomed, bulbs that existed only as promises written on scraps of paper. Within weeks, it all collapsed. The buyers vanished, the prices evaporated, and an entire merchant class woke up holding worthless contracts and wondering how they'd been so blind. Most people know this story. It's become shorthand for financial insanity, a cautionary tale told in economics classes. But here's what nobody tells you. It's happening again. Right now. In your world. The names have changed. Instead of tulips, we have artificial intelligence stocks. Instead of Amsterdam taverns, we have Silicon Valley boardrooms. Instead of handwritten contracts, we have algorithmic trading and circular financing deals worth hundreds of billions. But the psychology, the patterns, the mathematics of delusion, those are identical. And if you understand what really happened in 1637, you'll see exactly where we're headed in 2025. The Dutch Republic in the early 1600s was unlike anywhere else on earth. Fresh from winning independence from Spain, it had become the richest nation in Europe, perhaps the world. Amsterdam was the financial capital of the continent. The Dutch East India Company, the world's first publicly traded corporation, was minting fortunes. Ships arrived daily loaded with spices from Indonesia, silks from China, exotic goods that commanded astronomical prices. The merchant class was exploding. Suddenly, people who'd been shopkeepers or craftsmen a generation earlier had money, real money, and they wanted to display it. Enter the tulip. Tulips weren't native to Europe. They'd arrived from the Ottoman Empire in the 1500s, brought back by diplomats and botanists who'd seen them growing in Turkish gardens. In Holland, where a growing interest in botany and natural history was taking hold, tulips became objects of fascination. They were exotic, delicate, beautiful. And crucially, they were rare, especially the broken tulips. These were bulbs infected with a virus that created stunning flame-like patterns on the petals, streaks of red and white, purple and yellow, colors that seemed to dance across the flower. Nobody understood why some tulips broke and others didn't. The virus wasn't discovered until the 20th century. So in 1636, these broken tulips seemed almost magical, random, unpredictable, which made them perfect for speculation. At first, tulip collecting was a status symbol among the wealthy. Having rare bulbs in your Saint-Baudier garden showed you were cultured, connected, wealthy enough to indulge in beauty for its own sake. But then something shifted. People realized you didn't need to keep the bulbs. You could trade them. And you didn't even need to wait for them to bloom. You could sell futures contracts, promises to deliver a bulb at the end of the growing season. Suddenly, tulips stopped being flowers. They became financial instruments. This is where it gets interesting. Because what happened next wasn't some explosion of popular mania where the entire Dutch economy ground to a halt, as the famous Victorian writer Charles Mackay claimed. Modern historians have shown that Mackay exaggerated wildly. The tulip trade involved a relatively small segment of Dutch society, mostly urban merchants and skilled workers. The government never had to intervene to save the economy. The broader Dutch financial system kept humming along. But for those who were involved, it was devastating. And the patterns that emerged in those Amsterdam taverns and Haarlem auction houses are exactly what we're seeing today in tech stocks and AI companies. Here's how it worked. During the growing season, from roughly November to April, actual tulip bulbs couldn't be traded because they were in the ground, so instead, people traded contracts. You'd agree to buy a specific bulb at a specific price when it was finally lifted from the soil in the summer. These contracts could change hands multiple times before the bulb ever emerged. In effect, tulip traders had invented futures markets and derivative contracts, financial instruments that wouldn't become formalized for another 3 centuries. The prices were absurd. A Semper Augustus, the most coveted tulip with its flame-like red and white petals, sold for more than 6,000 guilders at the peak. To put that in context, a skilled craftsman in Amsterdam earned about 300 guilders per year. A nice house in a good neighborhood cost around 1,000 guilders, so a single tulip bulb was worth 20 years of labor or 6 houses. Other varieties weren't quite that extreme, but even common tulips were trading for prices that made no sense if you were actually planning to plant them. The speculation was purest. People were buying not because they wanted tulips, but because they believed someone else would pay more tomorrow. This is called the greater fool theory. You might know you're paying an irrational price, but you're betting there's a greater fool out there who will pay even more. It works until it doesn't. In early February 1637, something broke. An auction in Haarlem failed to attract buyers. Nobody knows exactly why that particular auction was the tipping point. Some historians point to an outbreak of plague making people reluctant to gather. Others suggest it was simply that prices had stretched so far beyond reality that even the most optimistic speculators started to doubt. Whatever the cause, once confidence cracked, it shattered completely. Within days, tulip prices were in freefall. Contracts that had been worth thousands of guilders were suddenly worthless. Buyers refused to honor their agreements. Sellers couldn't find anyone willing to take delivery of bulbs at any price. The legal system was overwhelmed with disputes. Many contracts were simply canceled with small penalty fees. For those who'd borrowed money to speculate, the results were catastrophic. They were left holding contracts to buy tulips at astronomical prices while the actual market value had collapsed to almost nothing. Some were ruined, relationships fractured, business partnerships dissolved. It was a localized financial disaster that, while it didn't crash the Dutch economy as a whole, left scars on those involved and created a cautionary tale that echoed through history. But here's what's important for us today. The Tulip Mania revealed something fundamental about human psychology and financial markets. When prices rise rapidly, people create narratives to justify them. The tulips are rare. The Dutch are wealthy. The demand will last forever. This time is different. These narratives feel rational in the moment. They're reinforced by seeing other people make money. They're amplified by social pressure, by the fear of being left out while everyone else gets rich. And once everyone believes the narrative, prices can detach completely from underlying value. They float free, untethered, rising purely on collective faith. Until one day, for reasons that might seem trivial in retrospect, that faith evaporates. And when faith is the only thing holding up prices, the collapse is swift and brutal. Now let's jump forward nearly 400 years. In 2025, the hottest thing in financial markets isn't tulips. It's artificial intelligence. Companies with AI in their name, or AI in their business model, or even just AI in their PowerPoint presentations, have seen their stock prices explode. Nvidia, which makes the chips that power AI systems, became the first company to hit a $4 trillion market valuation in July 2025. Its value had quadrupled since 2023. OpenAI, which launched ChatGPT just 2 years earlier, is valued at around $500 billion despite reportedly losing billions annually. Microsoft, Meta, Amazon, and Google are collectively spending over $400 billion on AI infrastructure in 2025 alone, much of it going toward data centers that will process AI calculations. The numbers are staggering. AI-related capital expenditures accounted for more than 1% of U.S. GDP growth in the first half of 2025. According to J.P. Morgan Asset Management, AI-related stocks have accounted for 75% of S&P 500 returns, 80% of earnings growth, and 90% of capital spending growth since ChatGPT launched in November 2022. The so-called Magnificent Seven tech giants, Alphabet, Amazon, Apple, Meta, Microsoft, Nvidia, and Tesla, now represent 37% of the entire S&P 500's total value, the highest concentration in half a century. Does this sound familiar yet? A new technology that promises to change everything. Prices rising far faster than earnings. Money pouring in from investors terrified of missing out. Companies valued not on current profits, but on stories of future transformation. Skeptics dismissed as dinosaurs who don't understand the new paradigm. This is the exact pattern. And just like in 1637, most people involved think this time really is different. They point to real revenue. OpenAI is apparently generating around $13 billion in annual revenue. They point to real applications. AI is being used in everything from drug discovery to customer service. They point to the fact that these are established, profitable companies, not speculative startups with no business model. All of this is true, and none of it means we're not in a bubble, because bubbles aren't about whether the technology is real. The internet was real in 2000 when the dot-com bubble burst. Railroads were real in the 1840s when that bubble burst. Tulips were real and beautiful in 1637. The question is never whether the underlying asset has value. The question is whether current prices reflect that value or whether they've been inflated by speculation, leverage, and psychological forces that have nothing to do with rational calculation. Let's talk about those psychological forces, because they're the thread connecting tulips to tech stocks. First, there's FOMO, the fear of missing out. This isn't a modern invention. It's a fundamental human drive. We're social creatures. We learn by watching others. When we see people around us succeeding, making money, getting ahead, we feel visceral anxiety about being left behind. Studies using brain imaging have shown that FOMO activates the same neural pathways as social pain and exclusion. It's not just greed, it's fear. In 1637, imagine you're a merchant in Amsterdam. Your neighbor just sold a tulip contract and made more in a day than you earn in a year. Another acquaintance has quit his job to trade tulips full-time, and he's buying a bigger house. Everywhere you look, people are talking about their gains. The taverns are full of traders. You start to feel stupid for not participating. You're watching money being made all around you and you're sitting on the sidelines. That feeling, that gnawing anxiety, is FOMO. And it's incredibly powerful. It can override rational analysis, risk assessment, even common sense. You jump in not because you've studied the market, but because you can't stand watching everyone else profit while you don't. Now, imagine you're an investor in 2024. Nvidia's stock has gone up 300% in 2 years. People who bought early are celebrating life-changing gains. Your coworkers are talking about their AI stock picks. Financial media is running endless stories about the AI revolution. Analysts are predicting trillion-dollar markets. Your portfolio, which doesn't have much AI exposure, is underperforming. You're falling behind. That feeling is identical to what the Dutch merchants felt. The technology is different. The timescale might be compressed, but the psychological mechanism is exactly the same. And it's driving billions of dollars of investment into AI stocks, often by people who couldn't explain how a large language model actually works if you ask them. They're not buying based on fundamental analysis. They're buying because everyone else is, and they're terrified of being the fool who missed the boom. This connects directly to the second psychological force, herd behavior. Humans evolved to survive in groups. Following the crowd kept our ancestors alive. If everyone was running from a predator, you ran too. You didn't stop to analyze whether the threat was real. You followed the herd. This instinct is hardwired into us. It served us well for hundreds of thousands of years. But in financial markets, it creates disaster. Because markets aren't like predators, they're reflexive systems where prices depend partly on what people believe. When everyone believes prices will rise, their buying actually makes prices rise, which confirms the belief, which causes more buying. It's a self-fulfilling prophecy, until it's not. In Tulip Mania, herd behavior was visible in the taverns where traders gathered. You could see the crowd, watch their transactions, feel the energy of collective speculation. Today, herd behavior is amplified by digital technology. Social media platforms, trading apps, financial news channels, they all create the illusion of a crowd even when you're alone. You see posts about AI stock gains. You see charts showing parabolic growth. You see celebrities and influencers talking about the AI revolution. Your brain interprets all of this as social proof. If this many people believe it, it must be true. So you follow, you buy, you join the herd. And for a while, it works. Prices keep rising. Your decision seems validated. But here's what nobody tells you about herd behavior. It works in both directions. Just as crowds rush into assets during bubbles, they stampede out during crashes. The same FOMO that drove buying becomes panic that drives selling. And because everyone moves together, liquidity disappears. When everyone wants to sell and nobody wants to buy, prices don't decline gradually. They collapse. In Tulip Mania, that collapse happened over a few weeks in February 1637. In the dot-com crash of 2000, the Nasdaq lost 77% of its value over 2 years. In modern markets with algorithmic trading and instant communication, crashes can happen even faster. When machines detect falling prices and execute automatic sell orders, the feedback loops accelerate. Human emotion, amplified by technology, creates volatility that can erase trillions in wealth in days. The third psychological driver is what psychologists call confirmation bias. Once we form a belief, we seek out information that supports it and ignore information that contradicts it. This is universal. We all do it. But in speculative bubbles, it becomes dangerous. In the Tulip Mania, once you'd bought into the narrative that tulips were valuable and prices would keep rising, you'd notice every story that confirmed it. Someone made a fortune on a rare bulb. A wealthy collector paid an outrageous price. A new buyer entered the market. All of this reinforced your belief. Meanwhile, you'd dismiss the skeptics. They don't understand the market. They're jealous. They're stuck in old thinking. You'd find reasons why the negative indicators didn't matter. Maybe an auction failed, but that was just temporary, just a bad day, just random noise. Your brain, trying to protect you from the cognitive dissonance of admitting you might be wrong, would rationalize away any warning signs. This is happening right now with AI stocks. Believers point to every positive development, a new AI application, a company beating earnings estimates, a prediction of massive future growth. These data points get amplified, shared, celebrated. Meanwhile, the warning signs are dismissed. A study from MIT finding that 95% of generative AI projects fail to yield meaningful results? Ignored. Reports that companies are spending $560 billion on AI infrastructure, but generating only $35 billion in AI revenue. Rationalized away, the massive gap between investment and returns, explained as just early days, just growing pains, just wait and see. Any criticism is treated as Luddism, as failure to understand the revolutionary potential. This is confirmation bias in action. And it's incredibly seductive because it feels good. It's emotionally rewarding to believe you're part of something historic, something transformational. It's painful to consider that you might be caught up in a speculative frenzy that will end badly. But let's look at the actual evidence, because this is where the parallels become truly striking. Tulip prices in 1636 reached levels that bore no relationship to any practical use for tulips. Even the wealthiest collectors didn't need dozens of rare bulbs. The trading was pure speculation. Similarly, AI company valuations today have stretched far beyond what their current or near-future earnings can justify. Let's take specific examples. Palantir Technologies, an AI-driven data analytics company, is trading at nearly 70 times sales, not 70 times earnings, 70 times revenue. That means if you bought the entire company, it would take 70 years of current sales just to get your money back, and that's before accounting for any costs. This is a valuation that assumes not just continued growth, but exponential growth sustained for decades. Nvidia, despite being wildly profitable, has traded at over 40 times sales at its peak. These multiples are reminiscent of the dot-com bubble. During that era, companies routinely traded at price-to-sales ratios of 30, 40, even higher. The most infamous example was probably internet content companies with median price-to-sales ratios above 30. When the bubble burst, most of those companies went to zero. The few that survived, companies like Amazon and eBay, saw their stock prices drop 70 to 90% before eventually recovering years later. Now, advocates will say the current situation is different because today's AI companies are profitable, unlike many dot-com companies. This is partly true. Nvidia is extremely profitable. Microsoft and Google print money, but here's the catch. Much of the current AI investment is not showing returns yet. It's showing spending. Companies are pouring hundreds of billions into data centers, chip purchases, talent acquisition, all on the promise of future AI revenue. This is leverage, not financial leverage in the traditional sense of borrowing money, though that's happening too, but economic leverage. They're committing resources now based on expectations of future payoff. If those expectations prove too optimistic, the reckoning will be severe. We've seen this pattern before. During the late 1990s, telecommunications companies invested over $500 billion in fiber optic cables and network infrastructure, mostly financed with debt. The logic seemed sound. Internet usage was exploding. Bandwidth demand was growing. Future traffic would require massive capacity, but they overbuilt dramatically. When the dot-com bubble burst and demand collapsed, most of that infrastructure sat unused. The telecom companies went bankrupt. Their debt couldn't be serviced. The fiber optic cables, which represented real technology and real utility, were eventually used, but at a fraction of the cost their builders had sunk into them. The technology was real. The bust was real too. This is the risk with AI infrastructure spending. Data centers are being built at unprecedented scale. Microsoft alone spent nearly $35 billion on AI infrastructure in just the 3 months ending September 2025. Oracle is reportedly committing to spend $60 billion per year with OpenAI over 5 years, even though it expects to lose considerable sums of money on the rental of data centers to AI companies. These are enormous commitments. If the AI boom continues and demand materializes as expected, they might pay off. But if demand plateaus, if the productivity gains prove less dramatic than hoped, if competition drives prices down, then billions or even trillions in capital could be stranded in buildings full of chips processing queries that never arrive. The parallel to Tulip Mania here is striking. In 1636, people were planting tulip bulbs as fast as they could, anticipating massive demand. Growers expanded operations. Land was dedicated to tulips. People quit other professions to become full-time tulip merchants. All of this made sense if prices kept rising and demand kept growing. But tulip demand wasn't really growing. It couldn't grow indefinitely because tulips, no matter how beautiful, have limited practical use. When the speculative demand evaporated, all that infrastructure, all those planted fields, all those dedicated merchants became surplus instantly. The bulbs still grew, the flowers still bloomed, but nobody wanted them at those prices. Similarly, AI data centers will still exist if the bubble bursts. The chips will still work. The technology will still function. But if the revenue doesn't materialize to justify the investment, the economic value of all that infrastructure will crater. Let's talk about another eerie parallel, the role of leverage and derivatives. In Tulip Mania, the futures contracts were a form of leverage. You could control a valuable tulip bulb with just a deposit or a promise. If prices rose, you made enormous returns on minimal capital. This is incredibly seductive. It's also incredibly dangerous. When prices fell, you were obligated to buy bulbs at prices far above market value. Many traders were left insolvent. They couldn't honor their contracts. The legal system struggled to cope. Many deals were simply canceled or settled for pennies on the dollar. Today's AI bubble involves different instruments, but similar dynamics. There's traditional debt. Analysts at Goldman Sachs found that hyperscaler companies, the big tech firms with massive computing infrastructure, have taken on $121 billion in debt over the past year, a more than 300% increase from their typical debt load. Some of this debt is hidden in special purpose vehicles and complex financing structures designed to keep it off balance sheets. This is a red flag. Companies are using creative financing to fund AI expansion because the scale of investment exceeds what they want to fund from current cash flow. Why? Perhaps because they're not entirely confident in the returns, or perhaps because they want to maximize their position in case this really is transformational. Either way, the leverage increases risk. If returns disappoint, debt becomes a burden that amplifies losses. Then there's what's called circular financing. This is where Company A invests in Company B, which then spends that money buying services from Company A or Company C, which is also invested in by Company A. Follow that? It's deliberately confusing, but it's happening. Nvidia invests in OpenAI. Microsoft also invests in OpenAI. OpenAI then spends billions buying chips and cloud computing services from Nvidia and Microsoft. Oracle is investing in data centers for OpenAI, while OpenAI is paying Oracle for those data centers. OpenAI is taking a stake in AMD to develop alternative chips, while Nvidia invests in OpenAI. It's a web of cross-investments and contracted spending that makes it very difficult to determine where real end-user demand stops and circular money flows begin. This isn't necessarily fraudulent, it might be strategic. These companies are betting on AI and want to secure their position in the ecosystem. But it's reminiscent of the dot-com era, when equipment vendors would lend money to their customers so the customers could buy the vendor's equipment. It worked great while everyone believed in growth. When sentiment shifted, it all unraveled because the demand was artificial, created by the vendor financing itself. We don't know yet if current AI deals will prove similar. But the structure is concerning. It suggests that some of the reported AI spending might not reflect genuine end-user demand, but rather a complex game of financial musical chairs where everyone is betting that someone, eventually, will be willing to pay for all this capacity. Let's also examine the narratives. Every bubble has a story that justifies irrational prices. With tulips, it was rarity and beauty and status. With the South Sea Company in 1720, it was the riches of trade with South America. With railroads in the 1840s, it was the transformation of transportation. With the dot-com boom, it was the internet changing everything. All of these narratives had truth in them. Tulips are beautiful. Trade is lucrative. Railroads did transform the economy. The internet did change everything. But truth in the narrative doesn't prevent a bubble. In fact, it enables it. Because the kernel of truth makes the story believable. It gives people something to point to when they argue that this time is different, that the traditional rules don't apply, that anyone who's skeptical just doesn't understand. The narrative around AI right now is that it's the most transformative technology since the internet or electricity. It will boost productivity across all sectors. It will generate trillions in economic value. Every company will need AI to compete. This narrative is compelling, and parts of it are probably true. AI is powerful technology. It will have impacts. But the question markets must answer is not whether AI is important. It's whether AI is important enough to justify current valuations. And this is where the tulip parallel becomes instructive. In 1636, tulips were genuinely valuable. They were exotic, beautiful, difficult to cultivate, especially the broken varieties with their viral patterns. The demand was real. But the prices at the peak reflected not the value of having a beautiful flower in your garden. They reflected pure speculation. People weren't buying tulips to enjoy them. They were buying tulips to sell them to the next person at a higher price. The tulip had become abstracted from its use value. It was a token, a vehicle, for speculation. Similarly, AI stocks today have become abstracted from the actual utility of AI technology. Investors aren't carefully calculating the productivity gains AI will generate and then valuing companies accordingly. They're buying because AI is hot, because everyone's talking about it, because they believe others will pay more. This is why valuations have detached from fundamentals. Palantir at 70 times sales doesn't reflect a sober assessment of how much value Palantir's AI will create. It reflects exuberance. It reflects FOMO. It reflects herd behavior. These are the same forces that drove tulips to the price of houses. Now, defenders of current valuations will point out that tech stocks are still more reasonably priced than at the height of the dot-com bubble. This is true. The Nasdaq had a price-to-earnings ratio above 200 in March 2000. Today, it's around 30. That's elevated, but not insane. Tech profit margins have improved dramatically since 2000. The Magnificent Seven are real businesses generating real cash flow. All of this is accurate, but it misses the point. Bubbles don't require price-to-earnings ratios of 200. They just require prices that have risen faster and higher than fundamentals justify. And by many measures, we're there. Tech stock returns have been driven overwhelmingly by a tiny number of companies. The top 7 tech stocks have accounted for 3/4 of S&P 500 gains. The concentration of market value in these firms is the highest in 50 years. Anytime returns become this concentrated, risk increases, because if sentiment shifts on these few companies, the entire market suffers. During the dot-com bubble, tech stocks reached 47% of the S&P 500. Today, they're at 49%. The increase was more gradual this time, taking a decade rather than 2 years. But the end result is similar. The market has become a tech-heavy, AI-centric bet, and bubbles don't need to match historical extremes to pop. They just need to reach the point where prices can't be sustained by underlying cash flows. One crucial difference between Tulip Mania and today is information. In 1637, traders had almost no data. There were no financial reports, no standardized accounting, no real-time price feeds. Trading happened face-to-face in taverns and at auctions. The market was small, localized, opaque. Today we have immense amounts of information. Corporate earnings are reported quarterly. Analysts publish detailed models. Financial media reports every development. You can access price data and trading volumes in real time. This should make markets more rational. With better information, investors should make better decisions. But here's the paradox. More information doesn't prevent bubbles. It might even enable them. Because information isn't just factual data. It's narratives, stories, explanations. And in a bubble, information gets filtered through cognitive biases. Bullish information gets amplified. Bearish information gets dismissed. The abundance of data allows people to cherry-pick whatever supports their preferred conclusion. You can find an analyst report to justify any valuation. You can find a story to explain any price movement. The information overload creates an illusion of understanding while actually making it easier to deceive yourself. This is why sophisticated investors with access to all the data still get caught in bubbles. It's not about information, it's about psychology. There's also the issue of timescale. Tulip Mania lasted a few years at most, from the first stirrings of speculation around 1634 to the crash in February 1637. Modern bubbles can inflate for much longer. The dot-com bubble ran from roughly 1995 to 2000. The housing bubble that led to the 2008 financial crisis built for nearly a decade. The current AI boom, if we date it from the launch of ChatGPT in November 2022, is less than 3 years old. But speculative enthusiasm around AI and tech stocks was building before that. By some measures, tech stock valuations have been elevated since 2020. So we might be 4 or 5 years into this cycle. Does that mean it's near the end? Not necessarily. Bubbles can last longer than seems rational. As the economist John Maynard Keynes famously said, markets can remain irrational longer than you can remain solvent. Trying to short a bubble, to bet against it, is incredibly risky because you don't know when it will pop. It might go on for years. Prices might double or triple from here before collapsing. This makes timing almost impossible. Some investors who correctly identified the dot-com bubble went bankrupt shorting stocks too early, watching in frustration as prices kept rising before eventually vindicating their analysis. So predicting when the AI bubble might burst, assuming it is a bubble, is not straightforward. What we can say is that the longer it goes, the larger the eventual correction tends to be. Because more capital flows in, more leverage builds up, more infrastructure gets built on optimistic assumptions. When it finally reverses, there's more to unwind. Let's think about what a bursting of the AI bubble might look like. It probably won't be a single dramatic crash like Tulip saw. Modern markets have circuit breakers, automated trading halts, regulatory interventions designed to prevent freefall. But these mechanisms don't prevent corrections, they just slow them down. A more likely scenario is something like the dot-com crash. A gradual shift in sentiment. Maybe a few AI companies report disappointing results. Maybe returns on AI investments prove lower than expected. Maybe a recession hits and corporate spending on AI gets cut. Whatever the trigger, confidence starts to erode. Stocks that were trading at 70 times sales suddenly seem overpriced. Investors start rotating out of tech into other sectors. The outflows begin gradually but accelerate. As prices fall, algorithmic trading systems sell, margin calls go out, leverage unwinds. Companies that borrowed heavily to fund AI expansion face higher interest payments on debt that's no longer generating expected returns. Stock prices enter a self-reinforcing decline, not necessarily a crash, but a grinding bear market that erases years of gains. Companies survive. The technology continues to develop, but valuations reset to levels that actually reflect cash flows rather than hopes. Fortunes made on paper evaporate. Late entrants who bought near the top face years of losses. The economy as a whole slows as the wealth effect reverses. People feel poorer, they spend less. Businesses delay investments. It's not a depression, it's a correction. But for those caught on the wrong side, it feels devastating. This is what happened with tulips. The crash didn't destroy the Dutch Republic. Amsterdam remained a financial powerhouse. The economy continued to grow. Dutch ships still sailed the world. But for the merchants who'd bet everything on tulip speculation, it was ruinous. Relationships fractured, businesses failed, trust eroded. The social fabric of the trading community was damaged. People who'd considered themselves savvy investors realized they'd been gambling. And the tulips? They kept growing. But nobody wanted to pay house prices for them anymore. The speculative premium had evaporated. Decades later, tulips sold for modest sums reflecting their actual value as decorative plants. The bubble had been a detour, a collective delusion, a moment when prices completely detached from reality. There's one more parallel worth exploring, the role of inequality. Both tulip mania and the current AI boom occurred in times of significant wealth concentration. In the Dutch Republic of 1637, a newly rich merchant class had money to invest. They weren't aristocrats with inherited land. They were traders and businessmen who'd made fortunes in commerce. They had liquid capital and wanted ways to deploy it. Tulips offered that opportunity. Today, wealth inequality in developed economies is at levels not seen since the 1920s. The top 1% of households control enormous amounts of capital. They're looking for returns. With traditional investments like bonds offering low yields, they chase growth stories. AI is the perfect growth story. It's new, it's exciting, it's backed by serious technology. So capital floods in. Venture capital funds, private equity, pension funds, they all want AI exposure. This money chases the same stocks, driving prices higher. But here's the issue. When wealth is highly concentrated, asset prices can detach from what average people can afford or what average businesses can pay. The wealthy are bidding against each other for growth assets. They're not constrained by needing current income. They can afford to hold assets that lose money for years as long as they believe in future gains. This creates distortions. Valuations rise to levels that don't reflect the productive capacity of the broader economy. Eventually, reality intrudes. If the profits don't materialize, prices correct. And when they correct, the losses hit the same concentrated wealth that drove the bubble. But there's also a broader societal cost. Speculative bubbles misallocate resources. All those billions spent on AI data centers that might sit underutilized, that's capital that could have gone to other productive uses, infrastructure, education, research in other areas. When bubbles burst, not only are fortunes lost, but the economy has to deal with the hangover of misallocated resources. So where does this leave us? Is the AI boom a bubble like tulip mania, or is it a genuine technological revolution that will justify current valuations? The honest answer is, it might be both. AI is real technology with real applications. It will impact productivity and create value. But that doesn't mean current stock prices are rational. You can have transformative technology and a speculative bubble at the same time. In fact, You usually do, because transformative technology generates excitement, optimism, and FOMO, which are the perfect conditions for speculation. The internet was transformative. It also spawned a massive bubble. Both things were true. The same is likely true of AI. The technology will matter. The companies building it will have futures, but many current valuations probably reflect speculation more than sober analysis. And when that speculation unwinds, it will be painful. Not because AI isn't important, but because prices had gotten ahead of reality. What can we learn from comparing Tulip Mania to the AI boom? First, human psychology hasn't changed. FOMO, herd behavior, confirmation bias, these are constants across centuries. The mechanisms of markets have evolved. We have algorithms and derivatives and global capital flows, but underneath, it's still human emotion driving prices. Second, bubbles are hard to spot while you're in them. Everyone in 1636 had reasons why tulip prices made sense. Everyone today has reasons why AI valuations make sense. The narratives feel rational. It's only in retrospect that bubbles become obvious. Third, leverage and speculation amplify both booms and busts. Tulip futures contracts and modern debt-financed AI expansion serve the same function. They magnify gains on the way up and losses on the way down. Fourth, the bursting of bubbles is about psychology, not fundamentals. Tulip bulbs didn't suddenly become less beautiful in February 1637. Sentiment just shifted. Similarly, AI won't suddenly stop working if the bubble pops. Confidence will just falter. And fifth, timing is impossible. Tulip prices could have kept rising for another year. AI stocks could double from here, or they could crash tomorrow. Nobody knows. Trying to time it is a fool's errand. The only defense is to understand the psychological patterns, maintain skepticism toward narratives that sound too good to be true, avoid excessive leverage, and remember that every bubble in history, no matter how convincing the story, eventually returned to fundamentals. In 1637, when the tulip crash finally came, people asked how it was possible. How had rational merchants convinced themselves that flower bulbs were worth more than houses? How had the entire trading community participated in something that, in hindsight, seemed obviously insane? They asked these questions even as the broken tulips kept blooming in gardens, beautiful and worthless. In 2037, if the AI bubble has burst by then, people will ask similar questions. How did we convince ourselves that a company with $13 billion in revenue was worth $500 billion? How did we pour trillions into infrastructure based on models that assumed exponential growth forever? How did sophisticated investors, armed with mountains of data and centuries of financial history, repeat the same psychological mistakes as Dutch merchants trading flowers in taverns? The answer will be the same. Because we're human. Because FOMO is powerful. Because herd behavior feels safe in the moment. Because narratives that promise transformation are seductive. And because every generation believes their bubble is different, that this time the technology really is revolutionary enough to justify the valuations. Sometimes it is. More often it's just another chapter in the very old story of speculation, euphoria, and inevitable return to reality. So as you watch AI stocks soar and tech valuations stretch, ask yourself, are you seeing genuine value creation? Or are you watching Tulip Mania with better graphics? Are you investing based on careful analysis? Or are you buying because everyone else is and you're afraid of missing out? These are uncomfortable questions, but they're the questions that distinguish investing from gambling. Because 400 years after tulip bulbs sold for the price of houses, the pattern hasn't changed. The technology has, the venues have, the scale has, but the psychology, that's timeless. And if you can recognize it, if you can see the ghost of 1637 in every chart showing parabolic growth, then maybe, just maybe, you can avoid being the one left holding the contract when the music stops. If this changed how you see the AI boom or made you think differently about tech stocks, I'd love to hear your thoughts in the comments. Are we in a bubble? Or is this time really different? And if you found this valuable, make sure you like this video and subscribe to the channel. Because the more we understand about financial history, the better chance we have of not repeating it. Although if Tulip Mania taught us anything, it's that understanding and avoiding are two very different things.